Let's take the discussion forward. Trideep Bhattacharya, CIO Equities at Edelweiss Mutual Fund is now joining us. Trideep, afternoon. Thank you so much for your time. I want to start by the way you read how market absorbed the news of long-term capital gains definition, STT hike, all of that coming together, all three of them coming together, and markets reaction yesterday and today. The broader markets were supposed to crash, but they haven't. Does it show the maturity of the market?
It does. I think yesterday clearly, the market reacted that this was clearly as an adverse move. But then on net balance thought that this is basically a small pain for a medium-term gain. I mean, if you think about from an equities where the long-term capital gain stacks have gone up from 10% to 12.5%, assuming equity investors who come with a 3 to 5 year view, over a 5-year period, if your incremental return is down by 2.5%, then overall, you're talking about a 50 basis point decrement every year. And I mean, people who come to equities come with a lot higher asking rate of returns rather than just 50 basis points for it to swing that. I think better sensibility prevailed. That's one. But the longer term positive is that relative to all the asset classes, now the tax arbitrage is gone. So on a relative basis, when you put all the asset classes an even keel, equities could actually stand to benefit clearly because the earnings momentum on earnings growth so far at least has been kind of fairly robust. So I think better sense prevailed. So yesterday was a knee-jerk reaction. Today you are seeing some reversal of the move that you were seeing yesterday. Yesterday made a small cracked a bit. Now they are sort of coming back to normal. And I think within a day or two we'll be back to our bread and butter, which is earnings.
Trideep, I want to just for a moment go back to budget, especially the factors of production, trying to bring down the cost of capital, trying to bring down the cost of land also, a lot of reform work. We just had a mapping company on the show to talk more about it. But the idea, it appears in the next 4-5 years, if land is sorted out, availability of land, disputes on it, and all the paperwork can be done digitally. If that is sorted out, and because of superior growth and moderate inflation, the cost of capital may remain under check. Are we looking at a larger kind of attempt of the government to sustain growth on a prolonged basis here?
I think it's a great spot. And the way I would frame it is, I will add one more point to it. If you look at the delta between the interim budget and the final budget, it was basically the allocation of the RBI dividend. And if you sub-aggregate the RBI dividend, which was to the tune of 40 to 50 basis points of GDP, the government allocated about 17 basis points to increasing rural spend and employment generation schemes and all of those things which will boost employment over the medium term. But the rest of it, roughly about 22 basis points, 20 to 25 basis points, they had the leeway to either sort of, increase capex or for that matter, use it in various different ways. But what they chose to do is lower the fiscal deficit. And this is the most important point for people to understand and appreciate, that this lowering of fiscal deficit target to a number which has a 4 handle to it kind of is a big deal, particularly when global rating agencies start to evaluate India from a rating perspective. And that ultimately goes on to the broader point that you were making, that reduces the cost of capital overall as well, because the average rating goes up over a period of time. And ultimately what that means is India, as you know, given that we are a growth oriented economy, and particularly we are looking to orient ourselves towards manufacturing oriented growth, which needs capital. So we are a capital hungry nation. And from that perspective, lowering the cost of capital could be particularly good news for India as an economy over the next 5 to 10 years, because manufacturing-led growth is what we are aspiring to get into, and hence capital ease of getting capital could be kind of positive from the India Inc. perspective.
On the changes in F&O, STT, long-term capital gains, all of that put together, I want to understand, do you think the government will be able to calm down the froth in the capital market, which all of us know exists in some pockets in some fashion? Do you think that objective could be achieved this way, or should we be open to some more measures coming in from the regulator or the exchanges later on?
It's a great question. I would say that I read the lips more than the numbers that they are talking about. So earlier they and what I look what I read into is the regulator is looking to cut the froth wherever it identifies as one. Between Jan and March, they talked about mid and small caps, and they came up with the sensitivity analysis overall. Now, as they see, the worry is on the FNO side, and clearly on some of the, particularly in the options front, we do see over trading coming in. They have introduced a measure which will kind of, hopefully come down to a certain extent on the smaller ticket turnover. You see, the thing is, high net worth individuals and the big ticket investors, their trading is done from a position of knowledge. But the small ticket investor who comes in with small capitals is the one who could get whipsawed on the negative side. So to a certain extent, it will help. But if you really ask my honest view, it will probably not solve the problem. So I see this as a step in the right direction. I see what they are looking to do. Will that curb the issue? No. Every time over the last 5 years, you see they have increased the asking rate, which is the lot size, or in this case, the STT. Volume subsequently has actually gone up. The only thing is the kind of volume that will go up will be more investing type rather than speculation type. That's the hope, and hope it comes that way.
Sure. Trideep, let's move on and talk about market valuations, etc. How are your funds doing on, or I would say by now you would have taken stock of companies coming out with results. Are you comfortable with the kind of numbers which are coming in so far?
My expectation from this quarter is not so great, to be honest. My sense is that overall, if you look at this quarter results would reflect the results of a quarter which had a few situations going which are not particularly conducive to growth. One is basically extreme heat in government sensitive sectors, election quarter where a lot of activity was kind of slowed down to a certain extent and maybe get postponed. So as these factors get reflected in the numbers and companies report, my sense is that you will not see great shakes coming out of this quarter, though the company's outlook for the full year would remain the same. In many ways, this is a bit of a sort of a transition quarter from Modi 2.0 to Modi 3.0. So I would kind of hold my horses with regards to expecting great numbers coming out for this quarter. So far, the numbers that have come about kind of show the same thing. And hence, what we have done is over the last 3 months or so, incrementally, we have added to kind of sectors like IT and FMCG, which is helping us in times like these. So it's a transient stage, but we are a little more defensive than what we used to be 3 months ago. But we think this will pass, and come September quarter onwards, things will pick up from an economic activity standpoint. But if you ask me again, the outlook for this quarter, I am not counting chickens or hoping that great shakes will come out of this.
Before I let you go, what is your positioning right now? 2 or 3 spaces which you are actually most bullish on, and your stance right now, which extension of your cautious stance right now, and also where are you trimming positions?
So I think over the last 2 or 3 months, we have made tremendous amount of gains in capital goods. We still are overweight capital goods, but we have taken some money off the table, and that money that we have taken from off the table, particularly in areas like defense and some other parts of capital goods which have run quite heavily, we have allocated or reallocated to IT and FMCG. And that sort of, that by and large explains the point that I was making, that we are relatively a little more defensively positioned than what we were 3 months ago. We are positive on capital goods from the medium-term standpoint, but in the very short term, we think that some of the stocks have run quite ahead. In the areas that we are very bullish, we are overweight capital goods, though to a lesser extent than what we were earlier. We are particularly positive on power. We think that overall, as an area, companies exposed to power as a sector would do quite well. We are overweight IT. We have been overweight IT for the last 6 months. In fact, we launched a technology fund as well. That continues to be an area which helps us. And the final area that we have added on to of late is companies exposed to the rural economy. Not because of the budget, but because the monsoon take has kind of changed our take on the sector a little bit. We think that with 2 years of dried earnings, better monsoons, and a little bit of stops from a government which has probably got a little more fragile mandate than otherwise, would mean better days for the sector overall. So that explains my positioning overall.
Excellent. Trideep, always enjoy our conversations. Thanks so much for your time this afternoon as well. That was Trideep Bhattacharya talking about budget, market, and the areas he's liking in this place. But let's move on.